Welcome everyone to Vested Interest. This is Shane, and we are back for our weekly portfolio update. It is Sunday morning. We're going to take a look at what we did in the portfolio this week. We did add $1,246 in new capital. We are going to back off a little bit. I know this is down from what we've been putting in lately with my bonus split up over the last couple weeks and with big market pullbacks in the beginning of the year. I've been putting a little bit of money we had on the side into the market, but now that the market is starting to rebound, we're going to back off a little bit and try to build back up our cash position. But we will cover all the activity into the portfolio, any dividends received, options we were in, and the new positions that we are new capital added to existing positions, because that's my focus right now, really building out existing positions. Now, before we get too far in the video, if you could do me a favor, hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever I put out any new content. I do this video series, a portfolio update, every Sunday. Then I do a stock pick of the day video series Monday through Thursday when the markets, we take a look at a company stock that's pulled back on the day and run it through my screener. There is the thanks button down below for anyone who might want to help the channel out financially that way. Any money made from the thanks will go into my two daughters' custodial accounts. I'm going to split that up equally. Any other funds I get from YouTube from the ad revenue, which is how us YouTubers make funds a bit beyond the thanks button, will go into my portfolio and paying the taxes that we have to on anything we receive. I think I've gotten a whopping $5 so far in the channel in the last 3 years. So this is more a hobby than it is some way that I make money. I make my money in my day job. I am like you. I go to work every day. I'm married. I have 2 kids. So keep that in mind as well. This is my portfolio. I am not a stock guru by any means. So you should be doing your own research, understand what you are buying, and not blindly following me or anyone else on YouTube or any other outlet, mass media outlet, social media outlet out there. All right, options. Now, we threw in several options again this week, but just like any other week, it has not been a good year in options for us. Market's very volatile, and usually that is good for options, but I am very conservative with them. I want to keep the options or keep the positions that I'm running options on in my portfolio while collecting that options premium. So I'm not looking to sell out of positions per se, but whenever a company is overvalued, like Cisco, for example, I think is right now, AT&T, I think is a little bit right now, I will run some options on them. And if they were get to call away, hopefully be able to buy them back, do the wheel, which is what I like to do, run a covered call. Then if it gets pulled away, I'll do a cash secured put, try to get it a little bit cheaper than I sold it for, and collect premium on both ends. But as you can see, the 3 I put in this week, same results. CVS, a $69 call, and it's not like I'm looking for a lot of money here. 25 cents per share would have been the payout, the options premium on that one. AT&T, like I mentioned, I think is a little bit $29.50 call with 15 cent per share would have been the premium. And Cisco there as well, a $57 call and 38 cents would have been the premium. So it wouldn't have been a ton of options premium, but it would have been something, but none of them hit. We were trying to do 2 contracts of CVS, 3 of AT&T, and 2 of Cisco. Now, on the other side, it's been a pretty good year for dividends. The dividends are really starting to pile up and really impacting the overall portfolio. That dividend snowball is really starting to be able to visually be seen by the amount of shares I'm getting each time these companies are paid out. And that is the objective of the overall portfolio, for it to not only build whenever I am adding new capital, but for it to build on itself with the dividends reinvested. So as you can see here, we received $193.06 in dividends on April 23rd. And that was split up between 2 different companies here. We've got Cisco Systems, ticker CSCO. This is out of the information technology sector. They paid us $93.61. We do have the DRIP set, and the DRIP stands for Dividend Reinvestment Plan. That just means that whenever any company in the portfolio, if you have it set, it reinvests the dividends right back into the same company and buys more shares at the time the dividend is paid out. So you can see that. $93.61. It says negative, right? Because it went right back in and bought 1.66153 more shares of Cisco Systems. And similarly, Comcast Corporation, ticker CMCSA, out of the communications sector, they paid us $99.45. In my particular portfolio, and I use Ally Bank for my brokerage account. It's all or nothing. I would like them to change that where I can do individual positions, but whenever I set the DRIP, again, that stands for Dividend Reinvestment Plan, that means every position is going to automatically buy more shares, right? Just like Cisco, Comcast does the same, every other position, same thing. I am hoping that Ally goes in and changes that to where I could change positions, ones that I think were maybe overpriced to reinvest the dividend. I would turn the DRIP off on those and reinvest those funds myself. But my brokerage is all or nothing brokerage. Maybe they'll change that in the future. But here again, Comcast paid $99.45. That $99.45 went right back up in and picked up 2.87263 more shares. And again, as you can see, it is really starting to pile up as far as the reinvested dividends. I mean, 1.6, almost 2 shares there of Cisco. So that'll be, almost 8 shares that I'll get over the course of a year just with reinvested dividends. Same thing with Comcast, even a little more at 2.8. So same thing, it's going to pay out 4 times a year. 2.8 times 4, that's going to give me 8. That's 16. So it's going to give me 9.6, a little over 9.6, almost 10 shares over the course of the year if I don't add anything to Comcast. That is the dividend snowball in effect, right? We've already added capital to these positions and the shares we've bought already pay out dividends. Those dividends buy more shares. These new shares add additional passive income that helps to build that snowball also. So next time they pay out, it'll include this $6.51 in passive income added because of the new shares. And we weren't done. We received more dividends on April 25th here. Cisco Corporation, ticker SYY, out of the consumer staples sector, paid us $75.77. And again, we have the DRIP set, so this $75.77 went right back in and picked up 1.06376 more shares. And this new share, little over 1 share adds an additional $2.17 in passive income over the next calendar year. So same thing, this pays out 4 times a year, right? Paying me a little over a share right now, at least at what the cost basis is right now. A little over a share. It's right around $70 a share right now. So obviously if it goes up, I'd get a little bit less. But next one will include this $2.17 or part of it. So you're seeing I'm getting about 4 shares a year from Cisco without adding any new shares. That is, again, the dividend snowball or compound interest effect. That's what you're seeing. Time being the hill that snowball is rolling down. And the longer you allow it to compound, including adding new capital and the DRIP set, the faster that snowball will grow. Obviously, at some point, you'll want to start using those dividends to help pay the bills. But my personal plan, is to only draw out 70% of my dividends to live off of, or to pay some bills or whatever I'm going to do with it, invest in a company, invest in land, whatever I'm going to do with it, 70%, and then use the other 30% to reinvest back into the portfolio. So my portfolio should continue to grow with that 30% reinvested, and my dividend payout should continue to grow as well. And that's why I'm planning it that way. And then, my kids, my grandkids, my great grandkids, their kids, if they continue that same 70% draw out, 30% reinvested, it'll just continue to get bigger and bigger. More people will be able to pull from the portfolio and help sustain their lifestyle as well. And that is the plan and how you build generational wealth, at least in my opinion. All right, now we're into the new activity. This is new capital invested on Monday, the 21st, same day we tried to go in and do some options plays there that didn't work out. We added $742.69 in new capital. With that new capital, we added 1 share to Valet, picked up that 1 share at $9.12. 8 shares added to our HP Incorporated position, ticker HPQ. This is out of the information technology sector. Valet is out of the materials sector. That's a mining company out of Brazil. So 8 shares of HPQ at $23.45. 4 more shares added to our Lam Research Corporation position, ticker LRCX. This is out of the information technology sector. Picked up those 4 shares at $62.39. And 2 more shares to our Alphabet position, ticker GOOGL, again out of the information technology sector at $148.21. By the end of the week, this was, I think, $160, $161 right in there. And Lam Research was right back around $70. HPQ, I think, was over $25. A lot of the companies we've been adding to have really rebounded recently. Now, these new shares added an additional $15.36 in passive income over the next calendar year. Now, we weren't done. We went back in on Thursday, the 24th here, added $504.43 more in new capital. With those funds, we added one share to our Comcast Corporation position. We're probably going to continue to add to this one. It's down about 15% of my portfolio right now. I think it's a good value. Picked up that one share at $32.72. Added one more share. These are our weekly buys. I buy VTR, Vanguard's Total Stock Market ETF, and Schwab Strategic Dividend Growth ETF here, SCHD, every single week. It's been about 4 shares typically, but I upped that here recently since SCHD has pulled back and is below my cost basis. I wouldn't mind building this out while it's cheaper. Same thing with VTI. There's been a couple weeks where I've added 2 shares, but we're back to 1 here. But 1 share at Comcast at $32.72. 1 share of VTI, again, what part of our weekly buys at $266.99, and 8 shares of SCHD at $25.59. And this $504.43 invested, the new shares we picked up added an additional $13.22. So total invested for the week, $1,246.92. I'm thinking about changing this and maybe going total invested, total dividends received, and total options, so you can see it all here at the end of the video, and then the total passive income would make more sense because this total passive income includes all of that, right? So if I get dividends and they get reinvested, I include that total passive income as well as the new shares that I buy adds to this. So total passive income added $37.26. So back to growing the dividend payouts here, and it is slow growing, but a lot of the ones I picked up this week are low yield. So that's okay. Google, for example, and they did just recently raise their dividend, but only about 5%, which is what a little less than what I was hoping they would do. I was looking for around 10%, but along with that growth, dividend growth, they also announced another share buyback plan. So we'll talk about that a little more here at the end. But total passive income added $37.26. And here is the sector weight breakdown. Currently, communications makes up 10.53% of the portfolio. Consumer discretionary still waiting on a good buy here. We sold out of BABA, which we probably should have held. That one's done really, really well. But we made about a nice 20-25% profit right in there. I think it was like 22% and some change on that. And we sold out of Starbucks too, which Starbucks actually looks attractive again, but I'm really concerned with their payout ratio. But we are looking for something here. I know a lot of people are jumping into Nike, but I'll be honest, I'm really concerned with that particular company based on what's going on with tariffs. And I know a lot of people are looking at Target, but same thing. Target and Walmart could be severely impacted by tariffs or any disruptions to our supply lines. I think I was looking at Walmart's product line, and it is a significant percentage of their products on their shelves that come from China. So that is the one that's been hit the hardest with tariffs, so it will be impacted. So my point is, I think we might be able to get companies like that cheaper once the overall market and people start to really see the impacts over the next 6 to 9 months of what's going to go on with these tariffs. We have not started to see the impacts of the tariffs yet. And if you think we have, the market's not pricing that in, I don't think, personally, because when tariffs go on like that, it stops shipments. But you had a lot of companies in November, December, January, February, they were buying more product with the anticipation that tariffs were going to go in place. So right now, since tariffs have gone in place, we are not buying a lot of new products. They are putting stuff on the shelves that is in their warehouses right now. But if they don't bring more products in to replace those products in the warehouse, eventually shelves are going to go bare, folks. And that will not be good. But anyways, communications makes up 10.53 of the portfolio. Consumer discretionary, again, looking for something there. Consumer staples at 9%. Energy makes up 10.24% of the portfolio. Financials at 2.29%. Healthcare makes up 14.23% of the portfolio. Industrials at 6.92%. Technology makes up 18.83%. Materials at 2.41%. Utilities at 8.66%. REITs and real estate at 6.36%. and ETFs is starting to become a larger slice of the pie. Eventually, I imagine this will take over the entire portfolio. Currently sits at 10.53%. Now, over here to the right, you can see those same percentages that match up to the pie, as well as the dollar amount allocated to each sector as well. Here it is, folks. I show this every Sunday, and I say this every Sunday. I think it is important for those of us in this space to show our portfolios so that those of you viewing our channels can understand what we're doing, what it looks like, how the ups and downs of the market impact the portfolio, how having different positions, individual positions in the portfolio looks over time. You'll see the changes in sector rotations. For example, Kroger now is at one of the highest percentages for our portfolio. AT&T, same thing. If you remember, it wasn't but 4 or 5 months ago that Owens Corning was up by like 90%. But there's definitely been a rotation out of stuff like industrials, materials, and into things like consumer staples. Consumer discretionary is another one there's been a rotation out of. And there's been a rotation into things like consumer staples. So Kroger, Procter & Gamble still doing pretty good. Utilities, energy. So you can see now Kroger has become one of the largest positions. But anyways, again, I think it's important for those of us in this space talking about this to show you our portfolio so you can really see not just what we're talking about, but what does it look like. I think you'll learn more from seeing that over time than you will just from someone talking about investing. That's just my opinion. And it both ways, right? It can give you tips on good things to do. It can give you tips on bad things to do. Like right now, the positions in my portfolio, I think that are presenting some value. You can see they're in the red, right? I think Comcast is presenting some value right now. I actually think some positions that are in the green are still presenting some value. NextEra Energy, I think anything under 70 is a pretty good buy for NextEra Energy. SYY, same thing. I think anything around 72 or lower is pretty good for Cisco as well. So it doesn't, you don't just add to the greens, but that doesn't mean, and you don't just add to the ones that are in the negative for sure, but you also don't run and sell just because you're in the red or just because you're in the green either, right? That doesn't necessarily mean anything. You should be valuing these companies, watching the rotations in the market, and understanding where the value is in your portfolio, in your positions as well. So that's part of the reason I show the portfolio. I think it's important for people to see a real portfolio built out over time. The other reason is I want you to understand you don't have to be a stock guru. You don't have to be a financial guru. You don't have to have gone to college for it, and you don't necessarily have to pay someone to manage your money for you. You can do it yourself. There are a lot of tools out there now that weren't available, 10, 15, 20, 25, 30 years ago that are readily available at your fingertips now. We all are walking around with cell phones. You can download different apps. You can do everything on your phone. Most companies don't charge you any fees for trading now. They do still charge you for stuff like options. But buying and selling stocks, whenever I first started back in the early 2000s there, 2001, 2002, buying into Franklin Templeton, it cost me money every time I put, $150 in, and then I might invest out of $120 or $150, I might invest $110 and it'd be $10 in fees, or $140 and be $10 in fees, or $15 in fees, so $135, because they still charged you for fees. Most brokerages do not. And if your brokerage does, you should be looking for another brokerage. And most of them now, like I said, you can do Webull, you can do Robinhood, you can go to almost any bank. My bank is Ally, but there's SoFi Bank out there. Or you can go out to Fidelity, any of those, and have their apps right on your phone to where you're doing your own investment. You don't have to pay a financial advisor to do it for you. So don't think you can't. If you don't want to do individual stocks and do any research and understand how to look at a balance sheet, an income statement, then you can invest what Warren Buffett would recommend is into some ETF or index fund that tracks the S&P 500. Now, I do VTI. It tracks the total U.S. stock market. There's VT, which tracks the total world stock market. I don't necessarily like that one. If you're going to do that, do VTI and then find a ex-U.S. ETF, right? Something that covers the rest of the world, or an emerging market, or the Asian market, or European market, whatever your market you're looking at, or a blend of several markets you want to do, overseas markets. And then you can adjust whenever the foreign markets are down. You can put more into American market, or put more into European markets, and when American markets are down, you can put more into American markets. So you can control that a little bit, gives you a little more control over it, versus VT, where you're investing in everything, even the very, very small countries that are not growing at all or maybe in decline. So I choose VTE and SCHD for the two ETFs. Warren Buffett would recommend something that tracks the S&P 500, something like VOO, VOO, or SPY, SPY, or several of the other ones. Franklin Templeton has one. Every brokerage pretty much has Schwab has one. So every brokerage pretty much has something that tracks the S&P 500. But that is the reason I show my portfolio every week. Hopefully this helps some of you out there, again, to get some confidence to understand you can do it too. I am just like you. I go to work every day, Monday through Friday. I've got 2 kids, so we're always busy. My daughter's got a football game tomorrow, birthday today, so we're always doing something. And this is what I do in the evenings and on the weekends whenever I'm trying to manage my portfolio. That's how I work it into the time, and then buy, midday or something while I'm at work on my lunch break. But so I show this every week. I hope this is helpful to some of you. But anyways, I'm getting a little long-winded and don't want this to be too long. So we'll keep rolling here. Ticker, every position in the portfolio here, total shares as of the close of business on Friday. And all of these numbers are as of the close of business on Friday. I typically do my update on Sunday morning. Current price here, market value, that's for each individual position. What we saw on the previous slide was each sector overall. Average share price is here. This does include reinvested dividends. Purchase price, again, does include reinvested dividends. So it's not just money out of my pocket. It's also when you see those dividends are paid out, it comes into this purchase price as well. Total return, whether I'm up or down, I want you to see that. Percent return, whether I'm up or down, I want you to see that as well. What sector each position falls in. Here's where the quarterly, monthly, semi-annual payers, and you can see here, the highlighted in yellow are the companies that have already raised their dividend. As I said earlier, Google just raised their dividend 1 whole penny, so it was only a 5% raise. I was hoping for around a 10% raise, but along with that dividend raise, they also announced, I think it was a 70 billion buyback plan. So they're going to be pulling more shares out of the market. So that is another way companies return capital to the shareholder. So I don't mind that as well. I would have liked to have seen a 10% raise plus that share buyback, but I'm not going to be greedy. 5% raise beats inflation, so I like that. Current yield here, my yield on cost here, portfolio weighting. So again, what we saw on the previous slide was each sector weighting. This is each individual's weighting. And I do have a rule in the portfolio. I don't want any one position to be more than 10% of the portfolio. I don't want any one sector to be more than 20 to 25% of the portfolio. Here's the estimated annual income, payout months, dividend growth year over year. I update this as they update their dividends. So as you can see, again, Google just updated theirs from 20 to 21 cents, and it's a 5% dividend growth, which brings me overall to a 5.95% dividend growth year over year. So that's pretty good. Now, total shares, 7,389.312. Market value of the portfolio currently sits at $349,476. I have, including dividends reinvested, $332,580.93 into the portfolio, up currently $16,895.07, or 5.08%. I say this all the time. I do not really focus on this. Yes, it's nice to see that I'm up, but unless I sell out of all these positions in the portfolio, I do not lock in this gain. So it really doesn't mean much to me. It's what they call a paper gain. Right? It looks good on paper, but a 16% loss would just mean I'm buying these same shares cheaper. And if I'm still building out my portfolio, I want things cheaper for as long as possible, and then I want them to go up later whenever I'm drawing my dividends out. So I'm not really focused on this. Current dividend yield 3.664%. My yield on cost 3.85%. And this is what I'm really focused on. That's why it's circled in red. The dividends paid out by all the different positions in the portfolio over the next calendar year sits at $12,805.33. So we are back on the upswing as far as dividends go, back over $12,008. But really, we're back to where we were overall dividends, I think, about 3 months ago. So we're going to get back to 13,000 here probably over the next month and a half or so, as we add new capital and as the companies in the portfolio pay out dividends and those dividends get reinvested. It should start to grow pretty quick, and we'll get back to 13,000 hopefully by mid-June, right in there, which puts us, I hate to say, 4 months behind, because we're not really behind the 8 ball at all, but behind as far as where we were being paid 5 months ago. All right. So we're back on the upswing. It is good to see. And again, dividend growth of 5.95% jumped up a little bit with the update there to Google's payout. So back on the upswing. Let me know how your portfolio is doing. What dividends did you receive this week? What did you add to your portfolio? Any new positions? There are some nice ones out there with these recent pullbacks that have fallen into fair value or even showing some deals right now. Let me know what is, in your opinion, showing fair value in your portfolio, or what you've got your eye on that you'd like to add to your portfolio. And that is really it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So again, in the Stock Pick of the Day video series, Monday through Thursday, if you have a company you'd like me to throw in the rotation and look at it on a day its stock pulls back, go ahead and drop that in the comment section. And let me know what you are adding to your portfolio, what you're watching, maybe what you're selling. Maybe you're reallocating some funds, selling out of some positions and reallocating some funds right now with the market shakeup. Nothing wrong with that. I've definitely recently done that over the last month and a half. So it is part of portfolio building and part of portfolio monitoring. All right. This is Shane signing off. Wishing peace, prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion, investing journey, educational, and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.